Hey, this is the boss lady here. So I want to talk to you all today about the tax year 2022 tax credits that are going to be filed on your income tax return for 2023. I have had a lot of questions concerning the child tax credits, the earned income credits, and also the child dependent care credits. So I wanted to try to show you all as simplified as possible of how these credits work. Number one, these credits are divided into two different categories. You have what they call a set of refundable credits, and then you have some that are non-refundable. And then there's some that kind of go both ways. So basically what credits do is reduce your taxable liability, your tax liability on your taxable income. So I did a small spreadsheet with some simplified numbers to try to show you how these credits work. And I will show my screen here in a few seconds. But I wanted to let you know what these credits are, what they do, and how they affect your tax return. Now, I'm going to give you a little backstory because a lot of you who received those humongous tax refunds last year, $10, $15, $20,000 refunds, they will literally be cut in half, if not in thirds. So the ones who probably received 15,000 last year, you may see about 5 or 6, 7, 8,000 maybe at the most, depending on how many children that you're carrying and what your taxable income is and how much your actual adjusted gross income is. I know that's a little bit too much information for some of you to take in right now, but don't worry. Again, I tried to break it down in a spreadsheet to try to help you all understand. I'm going to share my screen here real quick with the spreadsheet. And here on the first tab, let me enlarge it a little bit. Make sure you see all the numbers. So what I did is I actually based it on a household which has one child. The person who's filing the tax return is considered head of household. And that is only because they have a dependent, a qualifying dependent. If you do not have any qualifying dependents to carry on your tax return, you cannot file head of household. I don't care how much money you made. I don't care if you made the most money in the house. The only way you can file head of household is if you have a qualifying dependent. So here we have a person that's filing head of household with one qualifying dependent. Their income, which more than likely is their adjusted gross income, was $55,000 for the year. Their income less their deduction, be it a standard deduction or itemized deduction, which that's another category that I'm going to explain the difference between on another video. So they had a standard deduction of $19,400. So what that means is Uncle Sam says, okay, you made $55,000 in your adjusted gross income, and we're going to go ahead and knock off $19,400 of that to lessen your tax liability a little bit. So that's what deductions do. Deductions lessen your income. Credits lessen your tax liability. So after Uncle Sam gives you the standard deduction of the $19,400, now your taxable income is only $35,600 instead of the $55,000. On an average, an average taxpayer pays about 10 to 12 to 15 up to 22% worth of their gross income in taxes a year. We're going to use the lower level, which is about 10%. If you can see here in my formula bar, we have sales income. Was $35,600. So you owe me 10% of that in taxes, which is $3,560. Number one, if your box 2 on your W-2, which is the taxes that were taken out, is less than that $3,560, that means you would owe Uncle Sam. If it was more than the $3,560. That means so, but this person has a child. So Uncle Sam says, okay, well, we're going to give you a little credit for having a child or taking care of a dependent. So once you go through the paperwork and your tax preparer fills out all these schedules and forms, they decide, okay, with that one child, you got the maximum, the $2,000 in child tax credit. That's one of the credits that has been lessened this year. Last year, Biden signed into effect, the Biden administration signed into effect the CARES Act. In the CARES Act, they gave people with dependents the $3,000 credit for each child in their household. Now, the last half of 2021, the Biden administration gave you half of that credit as an advance. That was the $250 and the $300 that you received every month between July and December 31st of 2021. So they said, okay, well, the other half, you'll get that back in your tax return. But we'll save that part for the next sheet. So right now in this tax return, you qualify for $2,000 worth of child tax credit. You have $3,560 in taxable liability as your tax liability. Then you figured out, okay, well, they put your child care expenses on there. So you qualify for $2,600 worth of child care credit as well. So you add those two amounts together and you come up with $4,600. Well, now you have more credit than you do tax liability. So what you do is you have to take the difference between the two. The difference is a negative $1,040, which means that inevitably you should have more credit left. But the IRS will only allow you enough credit up to your taxable liability, whereas your taxable liability is only $3,560. So basically, they're not giving you the rest of their money. So that's why it's called a non-refundable credit. These two types of credits are non-refundable, meaning they're not giving you anything else after they lessen your tax liability. So now, what happens is it says if it's 0 or less, you enter 0. So we'll just enter 0. So now you don't have anything left. So now the next line is on your 1040 on that second page, you have to put how many taxes were withheld from your paychecks throughout the year. So on your W-2, box 2, you'll have your taxes withheld. We're going to say they withheld $2,500 worth of taxes out of their check. So that goes on your 1040 on the second page. So then you go down and your tax preparer finish filling out forms and schedules and stuff and say, hey, well, on your income, you did earn $1,500 worth of earned income. Based on your income, based on your dependents, all of that is a factor. That's not the exact amount. I'm just throwing some even numbers out there to try to simplify it, like I said, as possible. So you had $1,500 worth of earned income. These taxes after your taxes that was withheld, these credits, I'm sorry, that was after your taxes that was withheld are called refundable credits. So you got $1,500 in earned income credit, and you qualify for an additional $850 in child tax credit. So that's something that, again, it's determined by your income, it's determined by all type of different variables on these forms and schedules. Let's say you went to school or you had a child that was in college and he received the 1098T, blah, 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 and you received $1,000 of American Opportunity Credit. Again, these credits are refundable. So what happens is you add those 3 credits up together and they total $3,350. So you get that credit back. That's refundable. Plus here, you also get the amount of taxes that was withheld out of your paycheck, which gives you a total refund of $5,850. That's the $3,350 plus the $2,500 equals $5,850. Sorry. So at the bottom line, that's how much your refund would be. But again, they're not giving you the whole 100% of your child tax credit this year. Last year for the CARES Act, they allowed you to take the whole deduction of your child tax credit as a refundable credit. The same thing with child care credit and also the child tax credit. They let you they refunded you the whole amount. They said these are going to be refundable credits this year. We'll do that for the, to try to boost the economy back up, give the people a little slack on the burdens. So that's how you end up with the 5850. You have the taxes withheld, you had some earned income credit, you had some additional child tax credit, and then you had the American Opportunity Credit for going to school, or you had a dependent that was in school. All those amounts equals $5,850. These credits, this child tax credit and child care credit, they're non-refundable. They only reduce the amount of tax liability that you possibly have. And last year you got about $3,000 or $3,000 for each child. This year it dropped down to $1,500 to $2,000. So that was a big chunk. Now let's do a scenario where again you have a head of household with one dependent, but the income is a lot lower. Now the income here was only $13,000, which actually ended up being their adjusted gross income. They took a standard deduction of the $19,400 because they are a head of household. When you take the difference of the two, you come out with a taxable income of $6,400. I'm sorry, not taxable income. Well, it's a negative $6,400. If it's a negative, it doesn't go below zero, so it just turns into zero. So basically, you have zero taxable income. So let me back that up because I did make a mistake. So you had $13,000 worth of income, and you had a standard deduction of $19,400, which is a credit, basically. So you had more credit than you had income. So they don't let you take anything below zero. When you have a negative number, that's below zero. So they stop you at zero. So that means you have zero taxable income. So Uncle Sam said, okay, well, hey, you don't owe us any tax. So that's why it's zero income tax liability here. You have sales C4 times 10%, which is zero, because C4 is zero. So you don't have any taxable liability. So now, since child tax credit and child care credit are non-refundable credits, and remember I said they are only used to reduce your tax liability, you don't have anything to reduce. So Uncle Sam says, well, hey, you don't need that credit. You don't have any tax liability. You don't have anything reduced. So you won't even see these credits. Your tax preparer should fill out the form just in case, because again, you could qualify for additional child tax credit, which is a refundable credit. So all of this is zero in here. You don't get the child tax credit, and you don't qualify for the child care credit. Now, again, your income was $13,000. Let's say you paid in your 10%, which was $1,300. So you pay that in out of your check on your W-2 box 2. It should say $1,300, taxes withheld. Now, the earned income credit goes up because your income is right at the threshold to receive the maximum credit. So for each child this year, well, for one child, the maximum earned income credit is $3,733. But again, that's not set in stone for every person or every taxpayer or every person that files. There's different variables in here to determine if you qualify for that maximum earned income credit. But we're going to say she or he qualified for the maximum earned income credit, which is $3,733. Let's say that they did qualify for the additional child tax credit, which here is $850. And they received the $1,000 for the school credit, whether it was them or a dependent who went to school full time. They received $1,000 for the American Opportunity Credit. Again, remember, these credits are refundable. So you received $5,583 in refundable credits, plus you get the $1,300 worth of taxes that was withheld out of your paycheck through the year. So your total refund would be $6,883. Now, the only reason I put this down here is to show you the difference between what it would have possibly looked like last year and what it's gonna probably look like this year. Last year, they gave you the full child tax credit of $3,000. If you did not receive that $250 or that $300 through those 6 months out of the year of 2021, you would receive the $6,883 plus the $3,000. And you would have received, let's say you had $2,600 in child care credit. You would have received the whole amount of child care credit. Which down here, if you look here, it says sum, you would have received $12,483 last year. And like I said, this year that's basically cut in half. So let's say you did receive $1,500 of that in that advanced child tax credit. So you would receive the $6,883 plus the $1,500 and then the $2,600, which would have still been about $10,983 because they advanced you $1,500 of that. That's basically adding this $6,883 and the $4,100. So I hope I didn't confuse you too much, but the key takeaway here is credits are divided into two parts. You have refundable credits and you have non-refundable credits. The non-refundable credits reduce your tax liability, which in the first scenario here, we had tax liability of $3,560. You only get as much credit up to the amount of your tax liability. We had $4,600 in credits. Our liability was only $3,560. So they give you worth of $3,560 worth of credit instead of the $4,600. Now we've wiped away, Uncle Sam wiped away all of your tax liabilities. Say, hey, you don't owe us anything, but we'll go ahead and give you the taxes we took out of your check, which is the $2,500. We'll go ahead and give you your earned income credit, the $1,500. We'll go ahead and give you some additional child tax credit, even though you didn't get the full child tax credit. And you went to school, or your dependent went to school, and you had $1,000 worth of American Opportunity credit. So that's how you would end up with a refund of $5,850. So again, if you compare the numbers to this to what you possibly received last year, it is basically cut in half some people's tax return, because this year they may have made more than they made last year. This year a dependent may have fell off that they did, that a dependent they don't have this year that they had last year. So there's different variables, there's different things that go on in that tax return that determines how much of these credits you are allowed to take, how much your earned income credit is. And as you can see here, the more money that you make, the less credit you get. If your income falls right there within that threshold of max out, by all means, you'll get the maximum earned income credit per child that you have. For one child, again, it's like $3,700. For two children, a little over. These are not exact numbers, but this is the ballpark of it. For two children, it's about right at between 4 and 5. And then for 3 children, they max out at $6,953. I do know that, because I've done a couple of tax returns so far, and the maximum earned income credit up to 3 children is $6,953. But again, everybody don't get that. It just depends on what all is on your tax return. So I hope that kind of helped with some of the posts that I was putting on Facebook, with some of the comments that were being questions that were being asked and DM to me. And again, if you still need some further explanation on it, by all means, go to my website, www.pps-thesolution.com, and schedule a free consultation, and I can definitely explain it to you a little bit more. I hope to make more videos, make more posts, and try to communicate with people on a larger scale, because having one-on-one consultations and sessions kind of get lengthy, especially during the tax season. Don't forget that the tax season has started. My tax office is offering fast cash advances this year for people who qualify. I do have another sub office that's set up now in Louisiana for my hometown people. And I do also have a mobile app. If you go to my website, on the homepage, there's a button that says mobile app. When you click on that, it takes you directly to it. You can do a preliminary interview, and one of the tax specialists will give you a call to further discuss the tax return with you. So again, watch my videos, comment, like, subscribe, share. Please share, especially for people who need to understand how their paychecks work, how these credits, how these deductions work. There's even ways that you can. The one thing I also want to let you know before I go, it's very important. I've been wanting to talk to you about this. Most people, most taxpayers only get a refund because they have overpaid Uncle Sam throughout the year when they're working. So that's why it's very important for you to fill out your W-4 as accurate as possible, because that way they only take the minimum or the most that they need to take out of your paycheck throughout the year, and then you have that money extra to live off of, to live on. I mean, if you give them all your money throughout the year and you're living from paycheck to paycheck just to wait on a big tax return at the end of the year, and you don't know what type of credits are going to be out there, then you've basically given them too much money. That is why people get refunds. Now, people with children, especially 2 or 3 multiple children, they get the extra credits. They do, and I understand that. But the average taxpayer only get a refund because they've overpaid their taxes throughout the year. So, again, I do consultations on tax planning and all different types of things. I'm not a credit expert. People ask me about credit. I don't do credit. But anything dealing with taxes, I am an accountant. I'm a professional accountant. Been doing in the accounting field for over 23 years now. So I do know the regulations and the codes and the rules. So I'm going to let you go for tonight. I hope to put some more videos on here. If you have any more questions, make comments here. Hit up my website, schedule free consultations, and also bring me them W-2s so I can do your tax return. Have a good night.